Thank you, everybody. My name is Mike, and I'm going to be presenting today on the offers in compromise. I encourage you, if you have any questions at any time, to type them in, and I will get to them. Maybe not instantaneously, but at various points I'm going to take a look, make a habit of looking over to my left hand side and take a look at the questions. So let's jump right in. This is a little bit about me. I actually am a trial lawyer with a background in tax. I had an interest in white-collar crime, and that's what piqued my interest in tax law. I began to notice that most white-collar crimes are accompanied by tax fraud and tax evasion charges. So I felt that it would be helpful to put myself on a level playing field with the assistant U.S. attorneys from the tax department of the U.S. Attorney's Office by having a master's in tax law. And that's what the inspiration was for me to go back to school and get my master's in tax law. And these days, I do a lot of compliance work. I help U.S. expats navigate the labyrinth of requirements for maintaining compliance with their U.S. tax obligations. That's become a big part of my practice these days. So FBARs, Form 8938s, and all the other good stuff that goes along with that. I also specialize in a lot of audits and examinations, and I do handle local and state tax issues as well. So let's jump right into offers in compromise. I think a good way to back into this is to talk about the concept behind it. It can basically be reduced to the following, that when taxpayers have few assets and a little prospect of generating sufficient income to pay a tax liability in full, they may be allowed to strike a settlement with the IRS for less than the full amount due to settle their case. In the simplest way, that's basically what the concept behind an offer in compromise is. The IRS's acceptance of an offer in compromise conclusively settles the liability absent fraud or mistake. The Internal Revenue Code section that you might want to take a look at just to familiarize yourself with all of the procedures surrounding offers in compromise is 7122. It gives the Secretary of the Treasury the authority to compromise any tax debt owed to the government. If the government accepts the offer, then the taxpayer pays less than the full amount due to settle their case. The policy goal here is to achieve collection of what is potentially collectible at the earliest possible time and at the least cost to the government, while providing taxpayers with a fresh start toward voluntary compliance. And so I think if you were to extract the key parts of that, the key part of that would be the least cost to the government. There's those cases that the government realizes that it's kind of squeezing or it's trying to get blood out of a stone, and it realizes that it's only going to be able to recover a certain percentage of the tax liability. And what it does is it cuts its losses by taking whatever it can get from the taxpayer before the taxpayer's position becomes even more precarious and the possibility of any recovery is lost. The IRS will compromise tax liability on 3 grounds. The first is doubt as to liability, the second is doubt as to collectability, and the third is to promote effective tax administration. And the way I've structured this presentation is to examine almost on a microscopic level each one of these separately. So the IRS allows taxpayers 3 different payment options. The first is a cash lump sum offer, usually payable within 90 days. The second is a short-term periodic payment offer, which is payable over a 2-year period. And the third is a deferred periodic payment offer payable over the number of years remaining in the statute of limitations on collection. So I am going to talk a little bit about what happens with the statute of limitations when an offer in compromise is submitted. It's really very basic. The statute of limitations is told on collection when an offer in compromise is submitted by the taxpayer. And there's also other issues that do get triggered when an offer in compromise is submitted as well that we're going to talk about later on. A taxpayer can request an offer in compromise by submitting one of two forms. The first form, and I'm fairly certain that you are probably very familiar with these forms and you can probably see them or you can probably visualize them in your sleep. It's Form 656. It's to request relief based on doubt as to collectibility or effective tax administration. And this form includes a checklist for the taxpayer to use to determine whether he or she is eligible to file an offer in the first place. Form 656L is used to request relief based on doubt as to liability. There is a processing fee. The taxpayers must submit a $150 processing fee for offers based on doubt as to collectibility and effective tax administration. This fee does not apply to offers based on doubt as to liability. It's possible that since the time I prepared this presentation that processing fee has been increased, although I'm not 100% certain, so I would just, out of an abundance of caution, advise you to check to make sure that processing fee is still accurate, and I'm sure that the instructions on Form 656 spell it out. The fee is mandatory if the taxpayer earns $24,000 or more and is single. However, it can be waived in the case of low-income taxpayers, and low-income taxpayers are defined as those with income at or below 250% of the poverty rate. The processing fee is not refundable even if the IRS declares that the offer request is incomplete or incorrect and cannot be processed. The user fee may be refunded if the IRS accepts the offer based on effective tax administration, or the IRS accepts the offer because of doubt as to collectibility and the collection of an amount greater than that offer would create economic hardship for the taxpayer. So the cases where I tend to see the user fee being refunded or waived altogether is those who generally don't have the financial wherewithal to hire a professional for their services and are using the services of the low-income tax clinic. Generally, those are cases that are ripe for waiver of the processing fee or the fee being refunded altogether. Down payment. Most taxpayers have to submit a down payment before the IRS will process their application. This basically is a good faith gesture that the IRS insists the taxpayer buy into. It basically gives the IRS some peace of mind that the taxpayer is putting some money where their mouth is and is in good faith putting down what would otherwise be the first payment as part of their offer in compromise submission. So this advance payment is generally not refundable even if the IRS rejects the taxpayer's offer request. I can't tell you how many times I've been in cases where the IRS did just in fact reject an OIC submission, and then the taxpayer wants the money the down payment that they put down refunded, but unfortunately it is non-refundable. For lump sum offers, the taxpayer must remit 20% of the amount of the lump sum offer. For periodic payments, the taxpayer must remit the amount of the first proposed installment and then comply with their own proposed payment schedule while the offer is being considered. So that is actually a critical distinction between the periodic payment offer and the lump sum offer. With the periodic payment offer, not only must the taxpayer remit the amount of the first proposed installment, but they have to comply with their own proposed payment schedule while the offer is being considered, not accepted, but while the offer is being considered. So if the offer is being considered over a period of several months, which is not unusual, the taxpayer must stick with the payment schedule that he or she proposed. The IRS will waive the down payment requirement for low-income taxpayers and for offers based on doubted liability. The IRS processes an offer in compromise only if the taxpayer remits required payments, completes the full application, files all required tax returns, and pays the necessary estimated taxes, and is not in bankruptcy. So as you can tell, these threshold requirements are usually easily met. However, I always caution tax preparers to still take the time to go through this checklist and ask the client these questions to make sure that that an OIC isn't filed prematurely or isn't filed for futile efforts. So you want to make sure that all of these requirements are fully satisfied. If the IRS returns an offer to the taxpayer stating that it cannot be processed, can the taxpayer appeal the decision? No. And that's because the onus of ensuring that all the paperwork has been completed and that the fee is included and that the client is eligible for an OIC, at least at the threshold level, that onus is borne by the taxpayer and the tax professional that is shepherding him or her through the process. So if the IRS returns an offer to the taxpayer stating that it cannot be processed, there is no appeal rights available. What happens when the IRS accepts an offer in compromise? The settlement will not be reopened unless the taxpayer has falsified information, concealed assets, or there was a mutual mistake of fact. The taxpayer has to agree to fully comply with all filing and payment requirements for a period of 5 years from the date the IRS accepts the offer. If the taxpayer fails to carry out obligations under the agreement, the IRS does have the right to terminate the agreement and collect the originally determined liability. So I almost liken the offer in compromise as if it is equivalent to a probationary sentence that someone in the criminal justice system receives in exchange for pleading guilty. And the reason I make that I draw that parallel is because I am a practicing criminal defense attorney, and whenever a client of mine gets a probationary sentence, I always advise them that notwithstanding the probation, if they are ever violated, they could be resentenced to a prison sentence that they would otherwise have been eligible for if they didn't get probation. So similarly here, even though the taxpayer is on an offer in compromise payment plan, for example, that goes 5 years into the future, if the taxpayer fails to carry out his obligations by missing payments or by throwing caution to the wind and just being very willful and negligent when it comes to keeping up with the payments, the IRS can terminate the agreement and then collect the originally determined liability. So it's in the taxpayer's best interest to stay current with the payment obligations and not play with fire by missing payments or by becoming delinquent in any way. Because as I said, the IRS can terminate the agreement and then collect the originally determined liability. What happens if the IRS intends to reject the offer in compromise? There is an internal procedure that has to occur, and this is what goes on behind the scenes. It sets into play the following chain of events. First, there's an independent review of any proposed rejection that has to happen. The IRS cannot arbitrarily reject an offer in compromise until this independent administrative review has occurred. Second, if the IRS rejects the offer, the IRS must advise the taxpayer. That's very basic. If an OIC is rejected by either the examination or the collection function after an independent administrative review, the taxpayer will receive an explanation of all available appeal rights. So in answer to the question, does the taxpayer have the right to appeal the rejection of an offer in compromise? Yes. But again, the key word there is that there's been a rejection. If the IRS sends the offer in compromise submission back because it's incomplete, then that doesn't constitute a rejection. In that case, as we discussed earlier, any down payment that the taxpayer has submitted remains the property of the IRS. They don't get it back, and basically a new strategy has to be employed. But in cases where the IRS reviews the submission package and then makes a formal decision rejecting the offer, the taxpayer has due process, so to speak, in the sense that they can appeal the rejection. And what triggers this is the IRS rejecting the offer and then explaining to the taxpayer what their available appeal rights are. And so here we see that the taxpayer has the right to appeal the rejection to the IRS Appeals Division, or the IRS Appeals section of the IRS. He or she has 30 days from the date of the rejection letter to request an appeal. So from the day that from the date of the rejection letter, those 30 days begin to be count down, and there's no opportunity for the taxpayer to drag their feet. They can mull it over for a little while, but to the extent that they want to appeal, then they've got to advise you, their tax preparer, very early in the process in order to be within the 30-day time frame. May IRS Chief Counsel weigh in and provide an opinion on whether to accept or reject a taxpayer's offer in compromise? Well, the question actually is a little misleading. An opinion of the IRS counsel is required in all cases where the unpaid tax is $50,000 or greater. So there is no discretion as to whether IRS Chief Counsel can weigh in or not when the deficiency or the amount or the tax liability is $50,000 or greater. They have to, the examiner has to seek an opinion from Chief Counsel in those cases. An IRS Chief Counsel's review consists of legal and policy review. It's not a veto power, however, so IRS Chief Counsel's review could be at odds with that of the examiner, and yet the examiner could still go forward with rejecting the offer in compromise, notwithstanding IRS Chief Counsel's review and decision that the offer in compromise should be accepted. And so that's what's very interesting. However, if you're skeptical about something like that happening, you have good reason for believing so, because I would venture to guess that very few revenue officers would settle in the face of a negative Chief Counsel review. So essentially the revenue officers defer to Chief Counsel, and it's very likely that they are not going to do anything to undermine Chief Counsel's decision. Okay, I think... Okay, collateral agreements. This is interesting. It doesn't come up that frequently. However, I've heard of situations, and this does exist, where the IRS may condition acceptance of an OIC on the taxpayer's execution of a collateral agreement. And by collateral agreement, what I'm talking about is a supplemental agreement whereby the IRS basically comes up with a separate agreement in addition to the one made or proposed by the taxpayer for the taxpayer to pay the IRS a certain percentage of their future income over a specified number of years. And so here's a quick and dirty example. If a taxpayer has a potential to significantly increase his income over a short period of time, the IRS may require the taxpayer to pay over a certain percentage of future income in excess of a negotiated amount. So to back up a little bit, what we have here is a situation where the taxpayer has done an offer in compromise, and they have a suggested amount that they are proposing, and the IRS does not unilaterally reject that, but they come back and they essentially add on what's called a collateral agreement, whereby they offer or they request that the taxpayer agree to paying a certain percentage of the taxpayer's future income over a specified number of years. And this is what's known as a collateral agreement. So here's, we get into even more specifics. In this case, the taxpayer is a lawyer who's accepted a personal injury case on a contingency fee. And at the same time, the taxpayer lawyer has submitted an offer in compromise. If the case resolves within a certain number of years, say for example 5 years, the IRS might insist that it get 25% or 50% of any recovery amount from that lawyer's personal injury case that he's involved in excess of $100,000. So this is not, just to make a clear distinction here, this is the lawyer. This is not the lawyer's personal injury case. It's a situation whereby the lawyer is representing a client who's involved, who has a personal injury case. And the IRS, of course, sees the possibility that in the event of a settlement of this personal injury case, that the lawyer could potentially come into a substantial amount of money. And so what the IRS might insist as far as a collateral agreement is that it get a percentage of any recovery amount that is greater than $100,000. And for those of you who are unfamiliar with personal injury cases, settlements for personal injury cases are usually well over that sum, and sometimes go well into the 7 figures. So it's not unusual at all for an attorney who has or maintains a vibrant personal injury practice to recover settlements or verdicts at trial that well exceed 6 figures. So it's very practical here for the IRS to suggest a collateral agreement where it would request a certain percentage of an amount over this threshold. The IRS, however, they don't like these agreements because they have to be policed for 5 years into the future, and that requires, of course, more legwork. The IRS may withhold a refund from the taxpayer in the year that a collateral agreement is executed. Very important.
All right.
And here's a question.
Yes, thank you, Mike. This is our first polling question, and I know someone just asked about it, and you were about 30 seconds too early, so we'll take a brief second here. The first question is, the IRS allows taxpayers 3 different payment options, I guess, when submitting an offer. And I guess, Mike, you're doing pretty good. We don't really have any technical questions so far, so you must be providing all the answers.
Cool, and don't be shy to throw in any questions. As I said, I'm going to try to monitor the feedback, and if I notice that the question is something that I'm going to cover later on in the presentation, then I probably will wait until that moment. So you know, don't worry, but I want to get to everybody's questions if you do have them.
And a couple of people did ask about. A couple of people did ask about the presentation materials. They are in your My Events section online. That's njcpa.org/myevents. We'll also send out a copy attached to your credit letter, which will be emailed out in about a week or so.
Dave, can you also send in the ones on the installment agreements, just in case I don't cover those?
Yes,
or if
Yep, if you've already looked, there are 2 files there. The other one is on installment agreements. And if we do have time today, I think Mike is planning on touching on that briefly. So you'll get both of those files included in your credit letter. So that does conclude the poll. Thank you for answering. The answer was yes. There were 3 payment options. They were cash, short-term periodic payments, and then deferred periodic payments. So we'll turn it back to you, Mike.
Great. Thanks, Dave. So now we're going to delve a little bit deeper. We're going to go into offers based on doubt as to collectibility. These are by far the most often accepted by the IRS. They exist when the taxpayer cannot pay the full amount of tax liability owed within the remainder of the statute of limitations on collection. So what's happening here is that the taxpayer agrees that the tax is owed, but he doesn't believe that he can fully pay the balance due. This type of offer is initially considered by the collection function of the IRS and requires payment of the filing fee. So again, I want to stress here that the taxpayer is not disputing the amount of tax that is due. He or she agrees that the tax amount due is the proper amount. It's just that the taxpayer can't find or doesn't have the financial wherewithal to pay the balance due. In evaluating offers on this basis, the IRS conducts an examination of the taxpayer's assets, liabilities, and earnings potential. And as I'm sure you are aware, there is a special form for that, which I'm going to refer you to momentarily. But before we go there, let's talk about the standard that the IRS uses to determine whether an offer based on doubt as to collectibility should be accepted. The standard is whether the amount reflects a reasonable collection potential. So again, what's happening here is that the taxpayer is basically floating an offer to the IRS in full settlement of the debt. And the IRS is looking at that figure, and again, it could be a one lump sum figure, or it could be an amount consisting of monthly payments over a period of several years. Regardless, the standard that the IRS has to view this proposal under is a standard that you see here. Does the amount reflect reasonable collection potential? The definition of reasonable collection potential is that the offer amount must exceed the sum of the taxpayer's net equity and the taxpayer's future income determined over 4 or 5 years, depending upon the terms of the offer. So the example here, and again, this is a very general example, but I just want to, give you an idea of how this would work in practice. If the taxpayer owes $80,000 and reasonable collection potential is $30,000, but the taxpayer only offers $20,000, the taxpayer is going to have to increase his offer, and that's because the reasonable collection potential is $10,000 greater than the proposed offer that the taxpayer has made. So calculating the taxpayer's equity in assets. Equity in assets includes cash, amounts in checking and investment accounts, cash value of any life insurance policies, and accounts receivable. The realizable value of a taxpayer's other real and personal property is valued at its quick sale value. And the quick sale value is 80% of the current fair market value of the assets. For future income, and when determining whether the offer should be accepted based on doubt as to collectibility, the IRS also considers a taxpayer's earnings potential and the likelihood of any increase in future income. So the idea here is that the IRS, is going to look at each individual taxpayer and, almost do a very intrusive look at them to determine what their present state is in terms of work and earnings and what their future income or earning potential is. So for example, if there is a taxpayer who is maybe self-employed right now that is getting ready to make a jump into working into getting a job for a big consulting company, maybe Accenture or Ernst & Young, and their future earnings are going to more than double within the next several months, that is something that the IRS, of course, is going to factor into their whole future income equation in determining reasonable income potential. And going back to the test as we defined it, I'm going to go back. Does the amount reflect reasonable collection potential? As we discussed, the taxpayer's future income is factored into this reasonable collection formula because the offer amount must exceed the sum of the taxpayer's net equity and the taxpayer's future income determined over a 4 or 5 year period. To the extent that the taxpayer has more fruitful employment coming up, then that can be factored into the calculus in determining whether the offer that he or she has proposed, meets their satisfaction. And so the basic idea, as we discussed, is that if the taxpayer is moving on to perhaps greener pastures and is getting, a job that contains greater income potential, that's going to be factored into all of this. Now, the IRS will also look at expenses. So going back for a second, for income, it'll project into the future what it expects the taxpayer to be earning based on the taxpayer's present situation and what it expects him or her to be doing in the future. And that goes to what I was talking about before in the sense of the taxpayer who might be transitioning into a higher paying job with a consulting company or what have you. For expenses, the IRS projects into the future what it expects the taxpayer's expenses to be. So as you can imagine, expenses are important as well as future employment that might be more substantial than the employment situation that the taxpayer is presently in. So for example, if the taxpayer is taking care of an elderly or sick parent and the parent is in a nursing home, or the parent has substantial medical needs that require the assistance of a home health care aide, and the parent doesn't qualify for Medicare or Medicaid, and the taxpayer is financing this out of his or her own savings, that is going to factor into expenses that get projected out 4 or 5 years into the future. Other expenses that get projected out are perhaps the anticipated birth of a child that the taxpayer is going to have. So you don't want to leave any stone unturned, and that's why it's very important to understand and get to know your client on a very human level, because even though these forms read like hieroglyphics, at the end of the day, you need to understand your client as a complete person in order to accurately fill out these forms and in order for the IRS to have a holistic picture of the taxpayer so that they're not just looking at a Social Security number and they're not just looking at him or her as a cookie cutter mold. And that's why always take the time and get to know your client on a personal level. To determine the taxpayer's future income, the IRS will use information from the collection information statement, that's Form 433, in combination with estimated national and local living costs. These standards are disregarded if the resulting amount would leave the taxpayer unable to provide for basic living expenses. A taxpayer's future income, the formula for a taxpayer's future income is a taxpayer's monthly income minus allowable expenses. It's pretty direct and forward. Allowable expenses include food and clothing, out-of-pocket health care expenses, housing and utilities, and transportation. When we talk about food and clothing and we talk about out-of-pocket health care expenses, we are referring to a national standard. Housing and utilities are based on the standard living costs in the state and county in which the taxpayer lives. Transportation consists of ownership and operating costs associated with a car. So ownership costs are based on a national standard, whereas operating costs are based on a local standard. So you can imagine, a taxpayer living in New York and that is relying upon mass transit in the form of the subway system and buses and trains to get from place to place. Those local standards are going to lead to a substantially higher markup than the taxpayer who lives in Kansas and has a car that they rely on to get from point A to point B. So these are how the standards differ based on geography. The taxpayer, but now we transition into doubt as to liability. The doubt as to liability now, the taxpayer doesn't agree that he owes the tax. So when we talk about doubt as to collectibility, the taxpayer agreed that he owed the tax, but he was claiming that he doesn't have the money to pay the full amount. Here, insofar as doubt as to liability goes, the taxpayer disagrees that he owes the tax and essentially is disputing the underlying tax liability. Generally, the examination function considers this type of offer, and the taxpayer is not required to pay a filing fee. There are exceptions, and those exceptions are for offers submitted to compromise a trust fund recovery penalty, which is considered by the collection function. The trust fund recovery penalty is basically dealing with employment taxes, FICA taxes, whereby the employer has, for whatever reason, not held over the amount of FICA taxes that it should have held over, and as a result has become deficient in that department. And what the IRS does is they level what's called a trust fund recovery penalty to recover the amount of FICA taxes. It's a little bit, how can I put it, misleading, because when it calls it a penalty, but it's really the recovery of the taxes that should have been withheld and that weren't. So the trust fund recovery penalty refers to the FICA taxes that were not held over and paid. There are separate penalties that get tagged on to that, but the trust fund recovery penalty basically is focusing on the FICA taxes and other employment taxes that should have been withheld by the employer but weren't. And I apologize for the deviation, but just wanted to give you some background on that. Given that the taxpayer has other avenues available to negotiate with the IRS over the extent of his tax liability, compromises based on doubt as to liability are, in fact, rare. And you might have been surprised at first blush when I introduced this as a basis for an offer in compromise, because, as I'm sure you're aware, there are a multitude of ways to dispute the liability. And usually this happens in the form of, protest, filing a protest with IRS appeals to dispute the liability. And it also can escalate to the point where the taxpayer receives a notice of deficiency and decides to challenge the deficiency by filing the appropriate paperwork in tax court. So the notice of deficiency is essentially the taxpayer's ticket into tax court. And it allows the taxpayer to contest the liability in tax court within a 90-day time frame. So the taxpayer has the option to begin with a protest with IRS appeals, which is basically mediation with an appeals officer in the IRS's appeals section. And if that does not turn fruitful, then the taxpayer has the right to file the paperwork that would allow them to have the case reviewed by a U.S. tax court judge in tax court. And the notice of deficiency, as I said, is the taxpayer's ticket to get into tax court. And that is usually the way the taxpayers contest liability, beginning with protest and escalating all the way to tax court. Taxpayers may also contest liability in a refund or in a collection suit. Once liability is judicially contested, the IRS will not consider offers in compromise based upon doubt as to liability. Administratively, taxpayers also have these procedural rights, which I've just discussed, including invoking appeals office consideration to contest liability. Nevertheless, there are still those taxpayers that have not had the opportunity for effective review of their liability for assessed taxes, and they may not owe the taxes. In that case, they can rely upon this offer in compromise based on doubt as to liability to contest their liability for the underlying taxes. The taxpayers who apply for an offer in compromise based on doubt as to liability have to file Form 656L, and this form does not require taxpayers to submit a collection financial statement, as does the offer based on doubt as to collectibility. Now we're going to go into a hybrid of sorts. It is kind of a crossover between offer based on doubt as to liability and offer based on doubt as to collectibility. And in these combination offers, the liability issues are routinely considered first by either the examination or the collection functions, depending on the type of tax. And the reason why the liability issue is considered first is because if the taxpayer wins on that issue and is not liable for the tax, it would have been a waste of time for the IRS to have reviewed first on the grounds of collectibility, just to discover later on that the amount is that the taxpayer is not liable, because it becomes fruitless to have to do the collectibility function first before reviewing liability. So liability issues are considered first, and then if the taxpayer is considered liable, then the IRS examination or collection function will move on to the collectibility phase. And again, the reason why here is that to the extent the taxpayer is not liable for the tax, there's no reason for the IRS to go through the monotony of doing a complete investigation of the taxpayer's financial situation. If the revenue agent determines that the taxpayer is liable for the tax, the case will be forwarded to the collection function to consider whether the liability is collectible. And here we have a question. Dave, I'll let you jump in.
Okay, so poll question 2, and this one goes back to something you talked about a little earlier. The IRS determines future income using the formula, which is the taxpayer's monthly income minus allowable expenses. Is that true or false? We'll give people a few seconds to respond. And while we do, Mike, you have a couple questions here. How about the first one? This one's saying, is there a website that displays the historical proportion of the tax-paying population, individuals and businesses, that result in offers in compromise, like maybe trends or something like that? What percentage of cases end up like this?
You know, that's an excellent question. I have to be honest with you. I am not aware of that, but you know, being that Google is so user-friendly these days, I'm pretty sure that if you were to put these into the search engine, that you might come across a website that has been or that is compiling this data. And I mean, my first thought would be that the IRS website might be a resource for collecting data of this, because at the end of the day, they're a repository of, of these, statistics. But if you can't find it on the IRS website, I would Google it using different search terms that you've already put in your question, and I think that might turn up something that, some informative website out there.
Okay, and question 2, should retirement accounts be included in the equity calculation?
That's a good question. I'm pretty certain that by accounts, when we talked about accounts earlier, that they're very broad to include even retirement accounts. However, out of an abundance of caution, I would recommend reviewing the instructions that accompany the the offer and compromise and the collection information statement. That will probably spell it out in detail.
Thanks, Mike. And for the poll, the answer was yes. That is how the IRS calculates future income. So next we'll move on to offers based on effective tax administration.
Great. When it comes to offers based on effective tax administration, the way to wrap your head around this one is that this one is kind of the situation where you're pulling on the heartstrings of the IRS, and it's a very subjective standard. And you'll see here that when we as lawyers process effective offers based on effective tax administration, we oftentimes have to refer to case law as instructing us and guiding us on what type of cases would be appropriate and whether our client's case falls within the four corners of an effective tax administration submission. And you'll see why as we get into this. So needless to say, this one is rare. You don't see many offers in compromise submitted based on effective tax administration, but nonetheless, they're out there, and every so often they come up. So in what context do they come up? Even if the taxpayer's assets and income that allow him to pay the amount of tax liability owed, the IRS can still accept an offer in compromise so long as it promotes effective tax administration. So as you can see here, we're already starting behind the 8 ball if you have a tough examiner, because what is going on right now is that the taxpayer is stating, that they agree with the amount that they owe, and they're also, in addition, stating through their collection information statement that they have the assets and the income that allow them to pay the amount of liability owed, but they're relying on essentially an effective tax administration argument to pitch their offer in compromise. So again, if you're if you're looking at this from the perspective of a very formal revenue agent that's reviewing this, you can assume that they're going to be very skeptical and very cynical, because two out of the 3 are already satisfied. The taxpayers conceding that the amount of tax is the amount of tax that they owe. Secondly, they are conceding that through the collection information statement that they actually have the money in the form of the assets and the income to pay the amount of liability owed. But they are stating that there are other issues that should warrant them to pay less than the amount of tax that is due and payable. So on paper, the taxpayer can fully pay the liability, but there are circumstances that exist that with the acceptance of the offer, the public would be confident that the tax laws were administered fairly and equitably. Those are not my words. That's a standard that the IRS is using to view these effective tax administration cases. And so the issue becomes one of whether accepting this offer, will it promote effective tax administration? Compromising tax liability could promote effective tax administration for any one of the following reasons. First, the collection of the entire liability would cause the taxpayer economic hardship. Second, there are compelling public policy or equity considerations that provide a sufficient basis for compromising the liability. So those are the two basically the only two reasons that would allow tax liability to be compromised under these grounds. First, that there is a dire impact or an economic hardship on the taxpayer if they were forced to pay the entire liability. And second, that there is a compelling public policy reason that provides a basis for compromising the liability. So how would collection of the entire liability cause the taxpayer economic hardship? We don't have to look long and hard to come up with some reasons. Economic hardship might exist if the taxpayer faces a long-term illness, medical condition, disability, and it's foreseeable that his or her financial resources will be exhausted as a result. It can also cover cases where the sale or liquidation of assets to pay a tax bill would prevent the taxpayer from meeting basic living expenses. So if the taxpayer were to pay the entire amount and would essentially be left indigent and unable to meet their basic living expenses in the form of their rent or their mortgage, as well as their basic other living expenses from fueling the car to feeding and clothing their children, the taxpayer, the IRS would consider those in this whole taxpayer economic hardship calculus. And again, compelling public policy or equity considerations do provide a sufficient basis for compromising the liability. Compromise is justified only where collection of the full liability would undermine public confidence that the tax laws are being administered in a fair and equitable manner. That's the standard that the IRS is going to review this under. So at the end of the day, the IRS doesn't want to be viewed as the Grinch that stole Christmas. They don't want a bad public perception image, and they don't want the negative public relations that could come from shaking somebody down for the amount of tax that they owe, who is suffering from terminal cancer, or who has a child in the family who is gravely ill, or who is left destitute because of having paid this debt and is homeless. I mean, so all of these are kind of public relations issues or quagmires that the IRS desperately wants to avoid based on the perception that it would give to the public. And they don't want these things to come back to haunt them. No ETA offer will be accepted if it would undermine taxpayer compliance. So the IRS at the same time doesn't want to be made a fool of, and to the extent that word got around that they were compromising liability on grounds of ETA for taxpayers who just got back from a trip to Florida or from the Bahamas or the Cayman Islands where they splurged and were living it up and living the life of Riley, that of course would send a message to other taxpayers that that the IRS is the perfect patsy to take advantage of for an effective tax administration. So again, a lot of these deal with public relations and issues of that kind. The IRS will not accept an ETA offer if it determines that the taxpayer also qualifies for an offer based on doubt as to collectibility. However, if payment of the liability would still cause the taxpayer economic hardship, the IRS may treat the offer as one based on doubt as to collectibility with special circumstances. And if they do, they will still consider the same factors when processing the ETA offer. Once the taxpayer submits an offer in compromise, the IRS cannot levy against his or her property while it's processing the offer. So that is oftentimes a question that the taxpayer will ask you during the period of review: can the IRS levy on my property? And the simple answer to that is no. During the period that the IRS is processing the offer in compromise, hands off. The IRS cannot levy against the taxpayer's property. And how about in the aftermath of a rejection? Can the IRS immediately undertake collection action, say, for example, the day after the offer in compromise is rejected? The simple answer is no. Collection action is postponed for 30 days following rejection of the taxpayer's offer. And it could even go further into the future should the taxpayer decide to appeal the rejection. So the circumstance is one where if the IRS rejects the offer in compromise, then collection action is postponed for 30 days. But if the taxpayer decides to appeal the rejection, and taxpayers do have procedural due process rights to appeal the IRS's rejection of their offer in compromise. Should they do so, collection action is postponed during the period of the appeal. So again, collection action could be postponed for well beyond 30 days after the rejection of the taxpayer's offer. What gets most taxpayers is that, much to their chagrin, the statute of limitations for collection is told during any period in which the IRS is prohibited from enforcing collection. So sometimes you have to clear that up with your client, because they might be left with the false impression that the longer they drag the case out, the better that strategy is, and the more friendly, the better it'll be for them, because the statute of limitations will have expired on collections. Well, sadly, that's not how it works. During any period in which the IRS is prohibited from enforcing collection, the statute of limitations is told, meaning it's stopped. The clock is stopped. And there's no way to use that as a strategy to eliminate the amount that is due by prolonging a matter for an indefinite period of time until the statute expires. So make sure that you are very clear with your client, because I've oftentimes come across clients that have wanted to appeal rejections of their offer in compromise for no other reason than the fact that they thought that by stalling, the statute of limitations would be over and that all of this would go away. And so you have to be very clear to your clients that while the IRS can't levy on their property during 30 periods after the rejection of the offer, and if they were to appeal the rejection of the offer, the fact remains that the statute of limitations is told. If an accepted offer is payable in installments, the taxpayer may be asked to extend the statute on assessment for the period that the offer remains in force. This is not uncommon, especially as it says here, when the payment is being made in installments and is going, say, 4 years into the future. The taxpayer might be asked to sign an extension of the statute of limitations on assessment. And in those cases, the taxpayer basically has to sign that, and you have to make it very clear to them what's happening. and that you're essentially allowing the IRS more time to collect the amount in exchange for the acceptance of their offer in compromise. During the taxable year in which the offer is accepted, the IRS will also retain any refund that the taxpayer would otherwise be entitled to and apply that refund against the taxpayer's outstanding tax liability. That's another very important subtlety that you want to make sure your client understands, especially if they are relying upon refund for use in some other financial matter. You want to be very explicit in telling them that during the year in which the offer is accepted, the IRS will retain any refund. Now, IRC 7122 gives the taxpayer the right to appeal the rejection of an offer in compromise. The question becomes one of where does the right to appeal take the taxpayer? And as it states here, the appeal is to the Office of Appeals. So don't be misled here. It's not to the U.S. Tax Court. It is to the appeals section of the IRS. And these types of appeal, believe it or not, represent the second largest collection-related program in appeals, appealing the rejection of an offer in compromise. And these are just some procedural things, and I realize that we've reached the end of our time, so I'm just going to wrap up very quickly. When to request an appeal must be made within 30 days from the date of the rejection letter. The Appeals Division has no authority to consider offer and compromise appeals submitted after the 30-day period expires. And here's what I'm going to caution you. You have to be very diligent and mark your calendars or your smartphones, because when these letters come in, the days start counting down, and there are no exceptions to the 30-day rule, and it would be very, very, very bad to miss a deadline like this one, because the havoc that it could wreak on your professional license, not to mention penalties that you could possibly incur as a result of a failure to abide by the time period, is something you don't even want to fathom. So very important to understand these time elements, and that there's a 30-day period under which the appeal must be filed from the day the rejection letter is marked. Appeals will consider the same administrative guidelines and requirements that collections relies on. However, the appeals process offers an opportunity for a fresh look at the computation of reasonable collection potential. Appeals will use their settlement authority in offers filed based on doubt as to liability. They'll also consider offers in compromise that are submitted as a collection alternative in what are called collection due process hearings. And if a taxpayer's financial situation is complex or asset values must be verified, it's not unusual for appeals to ask compliance to conduct an evaluation and send them a report. Based on this investigation, the appeals officer will determine whether the offer is acceptable as submitted, whether the offer amount needs to be raised, or whether it must be rejected. And whether the appeals decision is final is based on the source of offer consideration. In equivalent hearings, the appeals decision is final. In a collection due process hearing, the taxpayer whose offer has been rejected has a collection alternative, has the opportunity for judicial review in tax court based on an abuse of discretion standard. And so that's going to wrap us up for today. If you have any questions, feel free to shoot me an email, give me a call. I am visible on LinkedIn and on social media. Whatever your preference, I'm always willing to brainstorm any issue that you have or help you troubleshoot any issue that comes up. And I just want you to know that my door is always open whenever you need it.
Thank you, Mike. So that does conclude today's webinar. I thank everyone for attending. And I hope all of you have a great Thanksgiving, hopefully long weekend, if you're off on Friday as well. Have a great holiday. We'll see you for next month's webinar on one of the 2 dates that were posted. And if you do need to jump off, you're free to go. So, Mike, I will ask you to hang around a little bit. There are a few questions here that you may want to take a look at.
Sure.
The first one, I'm not sure if this came over completely. What is the statute on collection?
The statute on collection is, I might have, usually the statute on collection, oh boy, I'm trying to think right now. I believe it's a 5-year statute on collection. I would have to look that up. So off the top of my head, I can't quote for you, but I believe that it's 5 years. But of course, there's so many exceptions that swallow up the general 3-year rule. So I would recommend just having a quick look at that on the IRS website. To what extent does the IRS consider business or individual taxpayer misjudgment bad operating or investment decisions in assessing hardship? I'm sure that there is probably a lot of case law surrounding that, because I would be hard-pressed to believe that argument hasn't been raised in one case or another where the taxpayer has argued that due to investment decisions they lost a substantial amount of money. If I would have to guess or hazard a guess, I'd say that the IRS is probably not going to probably look too kind to that, because at the end of the day, investments are investments and nothing is guaranteed. And, with all sorts of disclaimers, when you make an investment, you go into it with your eyes wide open, knowing that you could very well lose the entire investment. So I don't know if that's going to be favorable, a favorable argument to be made for an effective tax administration on the grounds of an effective tax administration. I think that what they're getting at are situations where there's something egregious that is going on in the taxpayer's life. And by egregious, the examples that I gave earlier are more relevant, where there's a terminal illness that the taxpayer is undergoing, where the taxpayer has a special needs child that is, that has, special needs and has requirements for medical attention and special schooling. Those types of things, I think, rise to the level of an effective tax administration grounds. And what reasons would qualify a taxpayer's appeal? Well, at the end of the day, I think that the argument would be over reasonable collection potential, because that's the standard that's being used to evaluate the offer in compromise. And so to the extent that the IRS rejects the offer in compromise, the standard being reasonable collection potential is something that can be argued on appeal. And as I spoke about earlier, and it was in the slide deck, I think, the appeals officer, if there is an issue with regards to reasonable collection potential, could shoot that back, the calculation stuff, back to the examination or collection function to recalculate the numbers based on perhaps newly acquired information. Now, that doesn't mean that newly acquired information that wasn't before the examination or collection function initially, that can't be re-argued or rehashed out when you're in appeals. But at the same time, if new information has surfaced since the rejection of the offer in compromise that goes to reasonable collection potential, then that would probably be the most likely grounds that the appeals officer kicks the matter back to the examination or collection function to recalculate the figures. But again, it could be based on the same factors that were argued initially, and just being perhaps couched in different phrases or argued in a different light, and that could result in the appeals officer kicking it back down to the appeals or down to the collection or examination function to have a relook and to recalculate the numbers.
All right, and I think that does it for all the questions, Mike. So thanks for sticking around a few extra minutes. I know we are over our time, and thank you for everyone else who hung around as well. I hope those sounded like good questions, and I hope that everyone else found some value in them. But Mike's information is up there if you do have any more questions. And I guess that does it for us today. Have a great holiday weekend, and we'll see you next month. Thanks, everybody.